Hello and welcome to Wall Street Vision, a show that explores investment ideas from the best investors in history. I'm your host, Vlad. This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. In this week's episode, I want to go over a few important ideas that Howard Marks covers in his book. The book is called The Most Important Thing. Apart from being a self-made billionaire, Howard Marks is the co-founder and chairman of Oaktree. That's an investment firm that's known for their expertise in distressed securities. Essentially, they're experts at investing in loans for businesses facing bankruptcy. That was Howard Marks' bread and butter in investing. Lots of people avoided that area of investing because the potential losses are big when you're dealing with companies that are facing bankruptcy. But at the same time, it was a great hunting ground because there wasn't that much competition for Howard to go up against. So here's Howard's 30-second bio. He was born in Queens, New York in 1946 and went to Wharton for his undergrad. He later worked at a company called TCW, and he was the big boss in charge of their US bond department. Here's where it gets interesting. While at TCW, he ended up organizing this distressed bond fund. Apparently, it was one of the first distressed bond funds from a major company, so it was quite an innovative idea at the time. So you can see that Howard was used to thinking outside the box to get unconventional investment results. In 1995, Howard and 4 other colleagues decided that they've had enough of the corporate rat race and wanted to leave and start their own firm. It was a pretty high-profile move because the people leaving TCW were very senior, so it made the headlines. Howard was 49 when he started Oaktree. Huge props to him for having the entrepreneurial spirit at that age. I'm sure at that point he had enough money to retire and spend the rest of his life snorkeling in Hawaii, but it's hard to retire when you're doing something you love. Oaktree went on to be a big success. Their assets under management today are around $140 billion. Howard himself has made a fortune from his original equity in the company, so his net worth is around $2 billion today. From what I've seen, that's a very common thing in investing, where the really good investors that stand out get most of their wealth from the equity they have in their investment company. Howard has a great track record, and he writes these quarterly memos that are really well known in the investment industry. You can usually find them online if you search around. Anyway, in 2011, he wrote this book called The Most Important Thing. Today, the most important thing is probably how to survive the pandemic with your sanity intact. But the book is from a decade ago, so it's all about investing. I enjoyed this read. I really liked the few points from the book that I want to share with you. The section I'm referring to is where Howard talks about first-level thinking and second-level thinking. In the book, he's pretty much saying that investing is really hard, so in order to be an above-average investor, you have to have superior insight. This superior insight is what he calls second-level thinking. First-level thinking is fast and easy. First-level thinking happens when we make a decision based on superficial information. First-level thinking is when your solution to a problem solves the immediate problem without considering the consequences. For example, you can think of this as, I'm feeling hungry, so to resolve this hunger, I'm going to eat a donut. The donut solves the immediate desire, but it's not the best solution. Second level thinking is more deliberate. It's thinking in terms of probabilities and looking at a series of outcomes that can happen. Second level people ask themselves, and then what? In our donut example, it's asking yourself the question of what will happen if you eat a donut each time you're feeling hungry. By asking that question, you'll see the consequences of your decision. This type of thinking would probably lead you to eating something healthier when you're feeling hungry. In investing, first-level thinkers all look pretty similar. Everyone reaches the same conclusions. First-level thinking is what the majority of people think about a stock. So if you look at a stock and there's 30 analysts covering it, and 25 of them have it as a buy, first-level thinking would be to buy the stock. This is where things get interesting. According to Howard Marks, the road to being an amazing investor can't come from first-level thinking. By definition, an amazing investor has to stand apart from the crowd. If they're just part of the crowd, then they're an average investor and not an amazing investor. This means that to be an amazing investor, their investing decisions have to be different from the consensus. By the way, when I say consensus, I'm just referring to the other investors in the market. Unusual investing performance has to come from an unusual way of making decisions, or seeing something that the majority of people don't see. I want to go over some examples from the book to illustrate this concept more. Let's say you have a fast food stock. First level thinking is just super simplistic. It's all about, this is a good company, their number of restaurants has grown a lot in the past 5 years, their food is great, and people love the brand. Let's buy the stock. Second level thinking would be, well, it's a good company, but everyone thinks it's an amazing company, and it's not. It's just good. So the stock is overrated and overpriced. Let's sell the stock. In this example, second level thinking is all about standing apart from the crowd. By the way, that's an uncomfortable place to be, so it's hard being a second level thinker. Not only do you need to have better insight, but there's also the social pressure of being different from the crowd. Here's another example. First level thinking says there's a negative outlook with low growth and rising inflation in the economy. Let's sell our stocks. Second level thinking in this case would be, well, the outlook is really bad, but everyone is selling in a panic. It's time to buy because people are selling good and bad stocks. So there's some deals to be had. If you look at the past two big market corrections in 08-09 and 2020, you'll see that a lot of great investors bought companies at very attractive valuations at those times. They saw the opportunity instead of being driven by fear. Second level thinking is about digging deeper and trying to understand what possible outcomes might happen. That's super hard, and that's why second level thinking is rare. Howard Marks says that when you're using second level thinking, you're thinking about things like the range of possible future outcomes, which outcome is likely to occur, and maybe the probabilities of each outcome and the probability that you're right. I think that makes a lot of sense. I think the future has a range of outcomes that might happen, and each of them has a probability. Second level thinking is about exploring the possible outcomes and thinking about the probabilities of each of them happening. Second level thinking also involves deciding about what is everyone else thinking of the stock and how is their expectation different from your expectation. Also, are the majority of people more optimistic or more pessimistic about the company? And what will happen to the price if you turn out to be right? And what would happen to the price if the majority of the investors out there turn out to be right? Those are the types of questions that are hard to answer and require a really deep understanding of the company and the industry. That's one of the reasons that investors like Warren Buffett recommend to focus on certain industries where you're the expert. Doing second level thinking is a lot easier if you're an expert. Doing this type of second level thinking is similar to what we covered in last week's episode on Charlie Munger's mental biases. In that episode, we discussed how important it is to look at reasons your conclusion about an investment might be wrong. If you're buying a stock, Charlie's thinking says to see all the possible ways that the price can go down. That's a form of second level thinking because it's all about going deeper into the decision-making process and looking at all the possible outcomes. So second level thinking helps you stand out from the crowd, and it also helps you avoid some mental blind spots. A lot of people consider investing to be a zero-sum game. Essentially, for someone to win in investing, another person has to lose. As a really simple model, that makes sense because if you buy a stock from someone and the stock price goes up, you're essentially winning at their expense. If you buy a stock and it goes down, the seller wins at your expense. It gets more complicated than that, but we can just use that as a simple model. Anyway, so if investing is a zero-sum game, and you want to do better than the average investor, you have to bring some sort of advantage or some sort of edge. Second level thinking can be one type of advantage. If most investors are first level thinkers, you can have an advantage over them by using second level thinking. Ray Dalio is another great investor and he talks about this as well. His perspective is that when you're making a decision, the first available option that you go with, or the first choice you make about a stock, can often be the wrong choice. You probably have these mental blind spots that are affecting your decisions, so it's important to explore the investment from lots of angles to see what you might have missed in your analysis. I think that second level thinking becomes more important when you look at really competitive markets. Let's say if you're looking at companies in the S&P 500, which is pretty much the 500 biggest companies in the US. The top companies will have 20 to 40 analysts covering them. That is super competitive, so if everybody's access to information is about the same, then to beat the competition, you have to be able to have better insight. Second level thinking is the superior insight that can be an advantage. Now, if you're looking at a company that's not widely followed, maybe a microcap stock, like the ones that Mike Berry used to invest in 15 years ago, you're probably going to see more inefficiencies in those types of markets. If there's only a few analysts covering a particular stock, there may be bigger inefficiencies in that type of market. So second level thinking would probably not play as big of a factor as it would in a super competitive market. I guess Howard's point is that second level thinking can be a great tool in any investor's toolbox. When your investment landscape is super competitive, you'll need to use something to stand apart from other investors. Having said that, second level thinking is super hard to do and it takes a ton of brain power. I think it's a good goal to apply second level thinking to the really big decisions, and this applies in investing and in life. Big money investing decisions or life decisions like where you should live or which university you should go to, which career to choose, and so on. Those are the types of decisions where it makes sense to do the extra work of second level thinking. These decisions have a big impact on your life, so you want to do everything you can to make sure that you're making the best possible decision. Thanks so much for listening, and I hope you have a great day.